So I'll start with the question that I think a lot of investors are asking, which is, why did you make the call to sell the BlackRock stake right now?
That is the question everybody's asking. BlackRock's obviously been a fantastic asset for us for years. They're a great company. But we had an opportunity to monetize, in effect, a great asset into readily available capital, which in this environment, I think is going to prove really valuable.
Some people are wondering if it means that banks are in more trouble than we may think, whether it says anything about either your own loan book and credit book or the broader banking sector right now.
It shouldn't. In our own loan book, and I think this is well known by our investors, we have a high quality loan book. It's evidenced by, past results of the Fed stress tests, and that holds true today. But what we don't know today is just the severity of this downturn. In all probable outcomes that everybody talks about, we think we'll have some recovery towards the end of this year. And if that's the case, everything's wonderful. But if that isn't the case, then having excess capital puts us in a great position, during the downturn to be on the offensive as opposed to being defensive and fighting to stay afloat. We and others lived through this during the financial crisis, and the firms with the most capital in a time of stress really do well.
The other question it raises, which it sounds like you're going to push against here, is what does it say about what you think about BlackRock and whether that business is fully valued at this point, given all the fee structure out there and what's happening in the markets?
Yeah, but BlackRock is a great company, and it's going to continue to be a great company. And nothing about our sale was a valuation opinion per se on BlackRock. Of course, at issue for us is if and when we wanted this excess capital, if in fact we could get the same value for it in a deep downturn, then of course we'd wait to see the actual downturn. But life doesn't work that way. And so you have to make a decision today, maybe through an abundance of caution, but to raise capital today for what might be. And that's what drives it today. But it's not a statement on BlackRock itself. Larry and his team have just done a phenomenal job, and they continue to.
Bill, it's good to hear that there's not anything specific in the loan book that worries you, but I wonder how you've seen things evolve amongst your companies, your loan book over the last couple of months. At the end of the first quarter, you booked $900 million of provisions, which took your funded allowance to 1.5% of total loans. You guided for another $250 to $350 million for Q2. Is that still on track, or do you think that provisions are going to have to increase more than originally expected?
And we guided to 250 or so of charge-offs, I think, and we said our provision would likely be elevated because since we closed the books in the first quarter, we did see the economy deteriorate somewhat. But there hasn't been. It's interesting, so far this quarter, the credit books have been pretty benign, and in many ways that isn't surprising given the amount of money that both the Fed and fiscal policy are throwing into the system. Behind the scenes, we and all the banks are, deferring payments from consumers and small business and, commercial and real estate. And we're kind of biding our time. And all of this is set up under the assumption that, a month or so from now, everything is going to come roaring back and all those deferments become current. So right now, there's not a whole lot to look at. The question is, if this extends out further, the deferments become real and they become permanent, in the sense that people won't have an ability to catch up. And that's what we're fearful of.
There's a wide discussion about what you're going to do with the billions of dollars you've raised now that you have that capital. What about M&A? What are you telling investors right now about the landscape, what it looks like, and how likely it will be that that's where you're going to be focused when it comes to deploying that money?
My suspicion is in disrupted markets, opportunities present themselves. And I don't know that we can predict exactly where they will come from. It could be inorganic and there could be acquisition targets. But, for the time being, I've been kind of telling people we're going to hang around the hoop and wait and see what, in fact, happens here with more information. What we saw without question during, the last downturn in the financial crisis was because we were in effect in good shape as a company, we had an ability to grow organically and play offense when a lot of the industry was playing defense and still shrinking to try to survive. And so whether we use this capital simply to support our clients and to grow organically, as we play this economy out, or we, see acquisitions, which are likely, we'll wait and see and see what presents itself. But I think they're going to be there.
What's the shape of the ideal acquisition, Bill? Is it another fellow bank, or is it slightly different? Is it fintech, payments, or consumer finance?
In its most likely form, it would be another bank. We're not, veering off from our strategic direction of wanting to establish a national presence on both retail, on both the retail and C&I side. We've been doing that through a digital strategy, primarily digital strategy with a branch-thin network surrounding it. The ability to accelerate that strategic direction through acquisition would be attractive. And it's a game we know well, and it's a game we execute on well, and it's in a market that's wildly fragmented. So I don't know that we need to get off of our game plan. Given what we've seen thus far, we continue to game plan. We just maybe have an opportunity to accelerate.
And Bill, what about the ideal size of target candidate? Would you ever consider giving up, you and your management team, control, or giving up even PNC's names? We saw a big merger of equals creating Truist last year. Is a merger of equals on the cards, or only you buying a smaller target and keeping the control that comes with it?
I think you're jumping way ahead of yourself. I think, we're going to be in a position, given our capital base, given the strength of the company, given our track record, to be the drivers in this outcome, and that's what we pursue.
Bill, broader question on what you're seeing right now. You lend to a lot of small business, a lot of households, and what you're planning as far as the second half of the year and when we might actually see recovery as we have started to see states reopen.
I think it's going to be in fits and starts. I think that the big question is we've given a bit of a lifeline between, 2.5 months worth of PPP to some businesses, unemployment that perhaps is in excess of what normal unemployment would be. The problem is that runs out in a couple of months. And as you start the economy in fits and starts, some people come back, some people don't. And unless it comes back in solid form, and bluntly, I don't think it's going to inside of a couple of months. I think you're going to see a lot of defaults and failures in the small business, smaller commercial, E-class real estate, and consumers continue to struggle. That's what has me afraid at this moment, that the window for us to basically get out of this lull is closing pretty fast. And it's going to take, I think you heard Chair Powell yesterday talk about the need for, greater fiscal stimulus, to continue. The Fed's doing everything they can do, but the window closes, and we kind of have to get the economy back. And the longer we wait, the harder it gets.